IRIN signed Microsoft directly and trades 46% below its high. Nebius signed Meta and trades 27% off its own. Same layer, opposite treatment. So here's my call at about 60-40 odds. That gap closes by the middle of 2027 rather than widening. And the reason is a number neither side advertises. Nebius depreciates its servers over 4 years. AEP depreciates transmission property over 15 to 79 years, which is to say it takes decades. Same demand, same year, same customers, and one of them has roughly 11 times the runway to earn its dollar back. The bigger gap is Nebius against CoreWeave, a larger market cap on a quarter of the revenue, and I think that converges too. I also don't expect AEP's $78 billion capital plan to be its final number, because the AI power chain isn't priced on electricity and it isn't priced on chips. It's priced on how long you get to earn a dollar back and on who signed for it. Start with 3 market caps pulled yesterday. American Electric Power, $65.8 billion. Nebius, $59.6. CoreWeave, $48.5. 6 days ago, that list ran the other way. Nebius was $75.5 billion, sitting above EP's $68.4. In under a week, the utility went back on top, and Nebius lost $16 billion of market value, with no earnings, no new contracts, and no change guidance at any of the 3. What moved was the price of duration, and it moved fast enough to reorder the sector inside a week. The strange comparison underneath still holds. CoreWeave has roughly 4 times the revenue, 2.5 times the backlog, and 1.5 times the capital spending of Nebius, and it's worth 19% less. Something is being priced here, and it isn't scale. Now the filings themselves, because both numbers are disclosed and nobody sets them side by side. In Nebius's 20F, filed in April, servers and network equipment are depreciated straight line over 4.0 years. In AEP's 10K, filed in February, transmission property carries annual composite depreciation rates of 1.8 to 2.7% across depreciable lives of 15 to 79 years. That is the whole story in 2 numbers. $1 Nebius spent on servers has 4 years to earn itself back. $1 AEP puts into a transmission line has decades and earns a regulator-approved return every one of them. These 2 companies are answering exactly the same demand, and they are not running remotely the same business. Now run Nebius's own guidance through its own accounting policy. Capital spending this year is guided at $20 to $25 billion. So take the midpoint of 22.5 and divide it by that 4-year life. You get $5.6 billion a year of depreciation out of 1 single year of buying machines. Nebius guides to $7 to $9 billion of exit run rate revenue. So 1 year of capex carries an annual charge equal to roughly 70% of where its run rate is headed. And the 41% margin the company reports is adjusted EBITDA, struck before that charge. Both things are true at once. The business is genuinely inflecting, and the accounting bill for the machines arrives right behind it. The utility answer is boring and extremely durable. AEP's 5-year plan is $78 billion, up from $72, with another $10 billion of line-of-sight investment not yet in the number, compounding rate base at about 11% a year. The part investors underrate is the funding. That entire plan carries 18% equity content, and a single $3 billion forward equity deal already covers the marketed equity need. The rest is regulated debt and cash from operations, earning an approved return. And AEP made the data centers put up $2 billion of collateral. That's a company that learned something. It's projecting up to $16 billion in fixed cost offsets flowing to residential customers, which is how you keep a regulator on your side while you spend. If you follow the AI power chain, subscribe because the next teardown is the memory supercycle that's repricing every server in it. Nebius solves the same problem in a completely different way, and it's genuinely clever. It gets the customer to pay first. Prepayments will exceed $9 billion this year. Roughly 70% of last quarter's deals carried 1. And on the 4 largest contracts, those prepayments covered 50 to 60% of the associated capital spending. That's why operating cash flow swung to $2.3 billion from minus $200 million a year ago. Then look at the debt. Its first secured facility, $775 million at a mid-single-digit rate, is backed by deployed GPS and the contracted cash flows of an investment-grade customer. Read that carefully. Nebius's borrowing cost is set by its customer's credit rating, not its own. That's the trick, and it's also the exposure. Now, put the whole chain on one screen, measured the same way. How far each name sits below its own 52-week high. Regulated utilities, down 8 to 13%. PG and E, Dominion, Duke, Southern, Exelon, AEP, Merchant and Nuclear Power, down 30 to 38. Constelin, Vitja, Thailand, the Bitcoin miners that converted to AI, down 41 to 48, every single one of them. 6 days ago, I pulled that same ladder, and every band sat 5 to 8 points higher than it is now. The whole thing moved down together and kept its order exactly. That isn't company news landing on 13 separate businesses. That's one factor being repriced across all of them at once. Pure compute still splits. CoreWeave down 43, Nebius down 27. That ladder isn't a power story. It's a credit story wearing a power costume. Look at who actually signed the contracts in that beaten-up layer. Iron's anchor is Microsoft, directly. 9.7 billion, 76,000 GB, 300s in Texas. TeraWulf has over 12.8 billion anchored by FluidStack, which is Google-backed. Cypher has 9.3 billion behind a 300 megawatt AWS deal. Applied Digital has about 11 billion in 15-year leases, and its counterparty is CoreWeave, a company itself down 43%. Microsoft, Amazon, Google, and a neocloud. Nobody in this layer prices independently. They're all subletting the same handful of investment-grade balance sheets. When Iron financed $3.65 billion, the coverage headline was literally, "The customer is the collateral." The whole chain is borrowing against the same 4 signatures, which is the risk I don't think any of these prices carry. So take the mechanism and the level together. These aren't independent credits. They're one credit wearing 5 tickers. A single hyperscaler slowing its lease pipeline doesn't hit one of these names. It re-rates the financing cost for all of them at once, because the collateral being underwritten is literally the same counterparty. And the tell won't be a cancellation, because nobody cancels. It'll be a renewal signed a lower rate, or a new tranche priced wider than the last one. The level to watch is Nebius's prepayment share, 70% today. That is the one number in this layer that says the customer is still funding the machines rather than the lender. Under 60, and the funding model re-rates before a single revenue line moves. So why is Nebius the good one and CoreWeave the doubtful one? On a quarter of the revenue? It isn't funding. CoreWeave has raised over $30 billion this year and describes its DDTL 4.0 facility as the first investment-grade rated financing secured by AI infrastructure in a customer contract. That's a better balance sheet than Nebius has. The difference is the clocks, and CoreWeave is running 3 of them at once. Reporting puts the useful life on its GPS at 6 years. The facility funding them runs about 5, and the revenue arrives faster than either. Its own filing breaks down a $103.7 billion contracted book, and 41% of it lands inside 24 months, 39% across years 3 and 4, with only the last 5th stretching past that. So 4/5 of the money shows up within 4 years, against machines being written off over 6. Nebius stacks the other way, with 4-year assets against a 5-year meta agreement. So its machines are written off before the contract ends rather than after. One more thing, and this one comes from reporting rather than the filing. CoreWeave stretched that GPU life from 5 years to 6 back in 2023, which lowers annual depreciation by hundreds of millions. Nebius did not. So the market isn't paying for scale, and it isn't paying for funding. It's paying for the company whose asset clock finishes first. And that's where I come out against the consensus read on this whole layer. The bulls call it an AI capex story, and the bears call it bubble, and neither is measuring the thing that's actually moving the prices. 11 times the depreciation runway for the same dollar of the same demand. That is the spread the market is trading, and almost nobody states it in those terms. Here's the asymmetry investors are missing on the utility side. Nebius's $40 billion backlog is layered. The meta headline is $27 billion, of which 12 is guaranteed and 15 is an option. The risk is that the number is softer than it looks. AEP's number is wrong in the opposite direction. Its incremental load pipeline is 56 gigawatts, double what it was 6 months ago, and the $78 billion plan was built assuming 13 gigawatts of Texas interconnection against the Texas pipeline now at 45. The plan is stale by construction, and its problem is throughput and execution rather than demand. That's a very different risk from a 4-year asset life, and it's priced at 19.6 times earnings with 463 consecutive quarterly dividends behind it, going back to 1910. Strip it back, and there are only two kinds of pricing power here. Statutory. A regulator approves your return, and you collect it for decades. Slow, capped, hard to kill. Contractual. Most of what a customer signs for lands inside 4 years, against machines depreciated over 4 to 6. Fast, uncapped, and it has to be re-won before the write-off. Only one of those survives its counterparty changing its mind, and the market is paying up for it. So, what I'm watching and what would settle it? Base case about 60-40. The Nebius CoreWeave gap closes rather than widens over the next 4 quarters. And I'd put it at better than even that EP091 billion goes up again. The plan assumes 13 gigawatts of Texas against a 45 gigawatt pipeline. 3 things to track. First, Nebius's exit run rate. $3 billion has to become 7 to 9, which is roughly 2.7 times in 2 quarters. That is the hardest test in this entire episode. Second, the prepayment share. 70% of deals carrying prepayments is what makes the 4-year asset life survivable. If that slips, the funding model re-rates before the revenue does. Third, EP's equity content at 18%. Break it and customer-funded growth quietly became shareholder-funded growth. AEP revises its capital plan with the next set of results, and that's the nearest dated catalyst. What would prove me wrong? Nebius hits the high end of that A, are arranged with prepayments intact while CoreWeave's backlog stalls. Then the market was pricing pre-funded cash correctly all along, and the gap deserves to widen. Upstream of all of this sits the same bottleneck as always. Interconnection queues and turbines, which I covered in the grid build-out episode. Downstream sits whoever ends up owning the depreciated machines in 2030. $1. 4 years on one side, 15 to 79 on the other. Take the midpoint of a EP's own composite rate, and it's about 11 times the runway for the same demand. I'm Big Z. Follow me. See you in the next deep dive.